Lesson 1, Part 2, Key Areas of Responsibility for the Financial Manager. In terms of the three main decisions then made by the senior finance executive or manager in many corporate companies, we can group these then into investment decisions, financing decisions, and dividend decisions. And we'll explore each of these in more detail because these are the three crucial decisions really that form the basis of AFM. Secondary responsibilities then include the communication to a number of different stakeholders in the business, be them external outside the business or internal inside the business. They'll also have responsibility then for the financial planning and control of the business, and they'll also then need to be aware of risk and how it can be managed. So firstly then, the investment decision. The finance manager's role then will be to choose the appropriate investments. And they'll have a wide range of ideas then about how the business might grow and develop in the future. The main aim though of all of these different techniques is to ensure then that the shareholders' wealth is maximised. Whatever strategy we go for, that's what we should always have our focus on. So they'll be responsible then for using a number of investment appraisal techniques that perhaps you've seen before, such as good old net present value and the internal rate of return. And we'll remind you of these as part of this course and also explore new techniques. But these are crucial then to assessing these investments. We'll also think then about capital resource allocation. We know for most businesses, or all businesses really, capital is limited. So how can we ensure then that we make the best use of this capital? How can we invest in the best projects then that deliver the biggest, the highest return, the most money there to our shareholders? We'll also need to think carefully then about non-financial factors. It's not just, money, profit. We need to think about ethical considerations. We need to think about the environment. We need to think about sustainability. The next key decision then for our finance manager is the financing decision. There are two key elements to this. Firstly, then the raising of finance. So firms will have a very wide range of different choices as to where they can raise their finance from, and we will explore this in more detail. But what we know then that the two main groups here are either equity, mainly coming then from our shareholders there, or debt, raising debt then from investors or banks there. What we might decide to do is use a mixture of those two. The other key consideration here then is to think about the cost of capital. Our job then, as a finance manager, is to maximise the wealth of shareholders. To do that then, we need to maximise the value of a company. Now, one way we can do this then is to minimise that cost of capital. Ensure then that the capital, the financing that we're using is as cheap as possible. If that's kept low, the company value then is kept high. Managers then, when they're thinking about this mixture of equity and debt, should choose the optimum gearing level. And again, we'll look at some theories on this. Ensuring then that gearing level brings down that cost of capital there as low as it can be. So in the financing decision then, we've really thought about how to get money into the company. In the investment decision, we've thought about what to do with that money. The dividend decision then is really how do we get that money out of the company? How are we going to distribute that then to shareholders? And how much of that actually should we retain in the business? So one thing we'll need to think about here then is the dividend payout. What do the investors prefer? Do they like big gains in the share price? Perhaps this is good for them in terms of their tax planning. Or do they prefer big payments of cash dividends today? We'll also need to think then about how much money to keep back in the business. Retained earnings then is a really important and often overlooked free source of finance here. There are no real costs associated with raising it. But the more money then that we hold in the business, the more unhappy our investors will become. So we'll really need to sell it to them if we want to retain those earnings. Moving on then to our secondary objectives here, we'll need to ensure then that we've got good, clear communication to our stakeholders. We might be a great business, but if we're not telling them that we're doing it properly, if we're not communicating that to them, then stakeholders here will fall out with us. So they'll need to be clear then about what our financial policy is. What are our corporate goals? We'll need to ensure then that we've got the right methods of communication, that they're not too waffly and long-winded, that they're nice and concise there. So it'll be really important to them then to explain new projects. These might be seen as inherently risky, but if we can stress to them that they'll deliver good returns, we'll get those stakeholders on side. We'll need to explain to them where that financing is coming from. Why do we need it? We'll need to be very clear to them about changes perhaps to dividend policy. For example, many companies cut back on the dividends that they paid during the coronavirus pandemic here because there was a lot of uncertainty and they needed that cash in the business. They were very clear with their stakeholders there, their shareholders, then they'll keep them on side. Those stakeholders then will come from a number of different places. We'll have both the internal and the external stakeholders, and they will require different bits of information. So on the external hand there, we've got our shareholders, we've got the general public, we've got regulatory bodies. There might be specific returns then that we have to make to those regulatory bodies. The public might want to know how we're operating in our local communities. Internally then, employees will want to know about areas such as job security. How is the business doing? What's its future outlook look like? Another secondary objective then is the financial planning and controlling of the business. So the finance manager here, the senior finance executive here, will be heavily involved in the planning of the raising of the finance for the year ahead. How much do we need? Where's it going to come from? What are we going to use it for? They'll be involved in the budget, the use of resources in the business here, helping then, the departments here think about the amount of finance that they've got available. They'll get involved in control activities. So they'll compare the budget to how the company is doing. Perhaps we might need to make some changes. We might need to address some adverse performance or perhaps repeat some good performance there. So they'll be heavily involved then in the evaluation of that performance. How did our actual cost of capital compare to what we budgeted there? How did our projects in terms of net present value compare to what we budgeted for a net present value? And they'll be heavily involved in the cash flow, looking at that perhaps on a daily, weekly and monthly basis and seeing then how that feeds into our financing there and our investments. The final then secondary objective here is the management of risk. So all businesses face risk, and specifically then we will need to think about the financial risk then that the company faces here and build this then really into our decision making. We'll need to be aware then of what risk appetite our investors have. Are they very cautious or are they happy there to take big risks? And this then will be very aligned really with the risk appetite of the company. We'll need to think then about how different risks are identified and monitored. What are the changes in the industry? Perhaps there's changes in interest rates there. What methods then can we use to manage these risks? So what kind of risk management techniques then do we have? Well, there's a wide range then of techniques, and we'll really look at these in more detail later on here in the course. But these techniques then will be selected and implemented to manage some key areas here. Interest rate risk. So the risk then of rates rising on our borrowings or falling on our deposits. If we're dealing then with foreign currency, we'll want to ensure then that the exchange rates here don't adversely affect our business. Investments for the future are inherently risky here. So how can we build risk management there into our investment appraisal? And finally, getting involved in that wider area there of the system for really managing and monitoring those kind of more general business operational risks.